risk-reward ratio trading is done exactly and precisely 100% wrong by most traders. Let me explain. Very, very important you understand this. And when I learned this, in fact, here in just a couple minutes, about 3-4 minutes, I'm going to share with you the secret sauce, the key that literally transformed my trading. I'm going to share it with you. How do most people do it? So how most people do it is they look at support resistance levels. In fact, let's just bring forward the chart here a few bars. And you could use different support resistance levels. We're going to use Fibonacci's right here for now, but it could be floor trader pivots, whatever. Retrace, we've gone from here to here. So now we've come down and retraced. So we have support here, and we have resistance up here. And they're going to say, this is my potential reward. And that is, as my grandfather used to say, humbug. Absolute malarkey. The amount of truth to that is exactly 0%. That's how bad it is. Let me back it up and tell you why. So first of all, let's go forward and let's actually look at this. And I would say, alrighty, that's my risk. If I was going to enter above that bar and put my protective stop below that bar, and then that is my reward. All right, so almost, well, let's see, what do we got there? Let's say it's 1, 2, 3. So we can go up 1, 2, 3, 3 to 1 reward to risk ratio, roughly. So is that true? And the answer is absolutely 100% negatory. That is bull cookie, as we like to say here at Top Dog Trading. And it goes sideways, and it comes back down, and it comes down, and it comes down, and then that's the end of the day. So it would have gotten stopped out, as you can see on this last bar. The next day, it gaps up. So was this really my risk-reward ratio? And the answer is no. Support resistance levels have nothing, let me repeat again, nothing, one more time, no thing to do with risk-reward ratio. And here's the reason why, is because they don't take into account the strength of money flow. And what makes markets move up, there's really only one thing. Write this down. You already know it. But god dang it, if you already know it, why aren't you employing it in your trading? And that is this. The only thing that makes markets move up and down is supply-demand imbalance. That's it. The strength of supply, the strength of demand. All this resistance means is, oh, the market went up there at one point. Well, so what? What's that got to do with whether the market's going to go up from here to there? Nothing. What does have to do with whether the market will go from up to there is, will it cover a large range of price action? Range of price action. Boom, right there. Hello. And how do we determine if price will cover a large range? And that, my friends, is the secret sauce, and here it is. The secret sauce is volatility, the energy of volatility in the market. Voila. Volatility is defined as the price range of the market movement, wide range, narrow range. And there's many different ways to measure this. So it's a short video, so I'm only going to show you one way right now. But again, a lot of you will know this. And Bollinger Bands are probably one of the most powerful, important, and well-known ways to measure this. What we're going to look at here is when we came back down to here, and we start coming back up, look what's happening. Bollinger Bands, coming down, 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 down. They're getting closer together. The range from here to here is wider than the range from here to here. So if I did enter this trade and I saw this happening, I would be out. I'd get out of that trade. I would take a little bit of profits. I would not worry about the potential reward based on where the market just happened to be last time. No, now I'm concerned only about what's happening in real time, bar by bar, on the hard right edge of the screen. The markets are not static. Support resistance levels used for determining risk-reward ratio in your trading is a static concept. And the markets are dynamic. They're constantly changing. Let me show you one more thing here to illustrate this. So what would be a different approach? A different approach would be to say, okay, look from here to here. And then the market, what does it do? It consolidates. We go into a low volatility period of time. And if you notice, now we get the Bollinger Bands squeezing together. So that's low volatility. So when we're in a low volatility period of time, I'm now looking to go into a high volatility period of time. These are called volatility cycles. Markets go, and by the way, cycle, just understand cycle is another term, a synonym for a period of time. Markets go from high volatility periods of time to low volatility periods of time. High volatility to low volatility. So we actually want to enter at the end of a low volatility period of time, because that's when they go into high volatility, and that's when we get our big move, and that's when we get our big reward. So here's the big picture view, so you can see these, what I mean by volatility cycles. So we have periods of time where there's low volatility, Bollinger Bands are close together, okay, and then they get far away from each other. So low volatility period of time or cycle, high volatility period of time. Low volatility, high volatility. Low volatility, high volatility. Okay? And now there will be times when the market is just kind of neutral. What do we do then? Nothing. We go look for another opportunity. Here's this is just fantastic. So here, low volatility, and then we go back into a high volatility cycle. Shall they transfer? Now, one last point on this, and we can use the same chart for this. So what happens is when we're in a low volatility market, the price range is narrow range. I don't care where your support resistance levels are, where you're drawing them from, if you're drawing Fibonacci levels or Gann lines or using astrology or whatever it is, does not matter. There's no volatility in the market. So we wait for a high volatility market, and then, wow, look at that reward. That's your reward time. Again, low volatility, then boom, market covers a wide range of price, big reward. Low volatility period of time, kablambo, big reward. And then, of course, right here, very low volatility, expanding volatility, big reward. Regardless, for example, if you looked at this high here, or even these two highs, here you could say, oh, that's resistance. Doesn't matter. There's so much energy behind the market. The buying is overwhelming the selling. The demand is overwhelming the supply. And so therefore, these levels don't mean, well, we'll use my grandfather's word again, humbug. Now, one of my favorite trades, one of my most reliable trades that has the best, let's talk about win-loss ratio now. That is my rubber band trade. And what I'm actually doing in the rubber band trade is I'm doing the opposite. So I wait for the market to get way out of whack with high volatility, and then I trade it back to the reversion to the mean. And that's another trade you can do it. So you can trade it both ways. You can trade the expanded volatility, and then once it gets up there, you can trade the reversion to the mean trade. And frankly, those are easier, and the win-loss ratio is way better, super high win-loss ratio. And I just happen to give away that trade strategy for free because I know you hear from a lot of different trading instructors. You don't know who to believe. And so I figured the best way to share with you that I know what I'm talking about and that I can actually help you is by just giving you an actual trade strategy that you can use and make money with. Give it to you for free. Try before you buy, or heck, try and never buy, and start making money. And I give this away. It's there's a couple of videos, about 5 videos that walk you through the trade strategy called the rubber band trade. Go make some money with it. So just go to rubberbandtrade.com, pick it up, test it. Of course, trade it on the simulator first. If you have any questions, you can email me about it. You'll get my email when you sign up for the trade, and I'm here to help you. So enjoy. And oh, by the way, subscribe to the video if you want to get more of these. By subscribing to the video, you get notifications whenever I post a new video, which I do 2 to 3 times every week.